All right, good evening, ladies and gentlemen. This is Clueless Trading Frank. This is a free strategic market update webinar. We're going to obviously talk in some stock too. And also we'll be covering some of the macroeconomic stuff, such as what is rocking the markets on certain days, which is the 10-year government bond yield. As yields are climbing, bond prices are dropping, causing some turbulence and indigestion in the bond market. And that sometimes spills over onto the equity side, and we want to be aware of that as we move forward into 2018. Very, very important for stock traders too. Use the bond market as a proxy for some of the things that might be happening under the surface. Keep in mind, well, I'll cover that in a second. Today is the 21st of January, almost a month end, 2018. Approximately 8:19 p.m. Eastern Standard Time. This webinar is a free webinar which is going to be uploaded to the Clueless Trading YouTube channel, which is for free viewing by all members, traders, as well as anybody out there who wants to basically learn a little bit more about the realities of the stock market and what we do, why we do, and why we do it better than almost everyone else out there. And please do pass the word around so they can at least view my videos, and then they can, on their own free will, join us in the exclusive club, which we call Clueless Trading. My website is www.clueless8.com. You can go in there, click on subscribe, join the free trial, or directly become a gold or platinum member. Whichever the case, I believe that for some new people who will be listening to this video, you can be taking a massive step forward in hopefully in your profits, most importantly in your approach to the U.S. financial markets and understanding it, quote unquote, the reality of it, not the fake stuff that you hear out there. Okay, on that note, full disclosure, this is purely for financial education and not for any solicitation or advice. And I'm very excited to have you guys here today. So let's start off with some of what's going on. Well, we know the biggest thing that's happening in front of us, the fight to keep the government technically has shut down as of Friday midnight. We know that, or 1 a.m. on Friday. So we are technically in government shutdown mode right now, and I am keeping my fingers crossed because it is very important to all of us, not just for the nation, but for the financial markets and for the overall harmony of the U.S. Financial and social system. After all, we are the most powerful nation in the world, and our government shuts down. It's like, what is going on? There's, I don't want to get into all the political stuff on it. You guys can read up on it. I've been putting out live updates on my Twitter feed, so people are aware of it. They don't have to look around. They can just click it, read it, and keep posted. I'll certainly be up well past 1 a.m. this morning to find out what exactly happens. So we're going to talk about that too, and the ramifications on the short-term ramifications, I should say, on the market if the government shutdown and the Senate bill is not passed and the shutdown remains in place going into tomorrow morning. I wouldn't like that personally, if you ask me. I don't like short-term disruptions of that type of things which are out of our control. So on that note, we wish everyone well, Democrats, Republicans, and everybody that's out there doing what they're doing. Let them hammer out whatever they need to do and get the ball rolling again. Get the government open. That's all we want. Okay, so at this point, let's talk a little bit broader about what's happening in the markets. First of all, what you see behind you is the 10-year government bond yield. Some of my older members know that I've gone through some of the macroeconomic stuff, which I'll be covering tonight, which are very, very important at certain times of the market. Those are the themes that control the market. Remember, Wall Street and the general markets pick up one theme and they run with it. Either it's a political crisis, either it's the European. Remember all the European Union crisis that was going on. Remember Greece? Markets were being just flailed around like a rag doll because of what was happening all the way in Greece, and Europe would fall apart and all that type of stuff. The Greek bailout. Then there was the Dubai crisis. There was the Chinese banking crisis, and now we have the government shutdown crisis. But from a technical and from an economic standpoint, the market is starting to get a bit worried about the sharp rise in government bond deals, which has a direct effect on the overall economy, because as rates rise, and this is what you see in front of you, as rates rise, going all the way back to 2009 here, so we have quite a few years that we're looking at, and as rates rise, it affects the average consumer. If mortgage rates, which are in the 4 to 5% range, spike up to 6, 7% range, obviously that's going to hit one of the biggest pillars of the U.S. Economy, which is housing. Mortgage rates go higher, less people buy houses, house price drops, has a ripple effect across the board. It has a wealth effect. It has a psychological effect. People start thinking of all the bad days when rates, when housing prices were dropping precipitously. That was for a completely different reason, obviously, because that was a mortgage crisis, not due to rates primarily. That was due to the fact that mortgages were being packaged and sold all over the world, and they had no idea what the hell CDOs, CMOs, and all kinds of derivatives, artificial synthetic products were, and that caused a massive financial crisis back in 2008 and 2009, between 2007 and 2009. So that's not the case at all right now, but we need to know what rates are doing. Now, at this point, let me just walk you through this chart, which you should look at once in a while. No, the TNX is the 10-year government bond, which is the proxy, which is directly tied in with your credit card rates and your consumer loan rates, your mortgage rates, and all that stuff. Okay, so it's a 10-year bond, the TNX. Now, the numbers you see on the right, and I'm going to go real kindergarten style here, is basically not 28%, it's 2.8%. Put a decimal point in the middle. If it was 28%, we would be in the gutter right now, okay? Obviously, we're not in the hyperinflationary stage, even though some people predicted we would be with QE and stuff. But I always said it would never happen, and it never happened, okay? Even in the wild days of quantitative easing, when every single month we used to watch the dates. If some of you remember, I know Corey remembers, I used to post the dates on the day they would be buying the open market operations, where they'd be buying the bonds, how much they'd be buying, and we would basically play the market as based on those factors too. QE ended 2 years ago. Markets are still going higher. All right, so bottom line is that so the way you read it is it's right now we are at 2.63%, right there, 2.639%. So rounded off to the nearest decimal, it's 2.64%. So we are right now at one second. Current yield is 2.64% on the government bond. That is 2.64%. There you go. Okay, so that's your y-axis. So bottom line is that when you look at this chart, you first thing you look at is where the rates are. You see that on your code screen too, on the TNX or whatever your platform uses as a symbol. Find out, and you can see clearly that since July of 2016, where we were having precipitous drops, and they were saying that said the U.S. economy is going to go into a massive recession. If you remember that, yields were down to a unbelievable 1.34%. See that right there? So you have to move one decimal to the left. So 1.33%. Like, wow. Like it's almost like free money, 1.33%. But that caused a sharp move actually down on the markets, because the market's like, whoa, what's going on here? All this money's going into and sitting in government bonds, which reminds me to explain one other very simple concept, which a lot of people don't realize. Prices on government bonds, oh boy, hold on one second. Sorry about that, guys. Okay. The prices, which I'll notate as P, of government bonds, so I'm going to call it BP, not buying power, bond, okay? So the bond prices are inversely correlated. They have an inverse correlation. That means when bond prices are going lower, that's known as inverse correlation, as you know, yields are going higher, and vice versa. When bond prices are going higher, yields are going lower. Everyone clear on that, right? It's an inverse correlation. So at this point, with yields going higher, bond prices are going lower. So that means there is a pressure. There's a margin pressure because the bond market, like the stock market, by the way, the bond market is almost 6 times bigger in size than the stock market. It's that if you consider it to be like an iceberg floating on the ocean in the Arctic or something, the real iceberg, they say only 1/4, 20% of the iceberg or 25% is peeking out over the waters, right? You guys know that. So the other 75% is under the water on these big, massive continental icebergs, okay? So the bottom line is the bond market is that. That's the bond market. On top of that, the stock market, what we call, I'm going to put stock, stock I'm going to put. So the stock market is basically a small baby in size compared to the multi-trillion-dollar. I'll tell you what that number is in a second. It's not on the top of my head. Of the bond market. So if there is a price drop in the bond market, as we are seeing, as yields are rising, prices are dropping, right? Just follow me clearly. Prices are dropping in the bond market, and the bond market also has a lot of leveraged players. In other words, borrowed money, because what was going on was this was a massive overall. That was a massive drop in yields all the way from October 14th. And going back to 2019, yields were at 4.3%. 4.3%. Okay? If I go back years and years, it used to be 10% plus. So bottom line is the bond yield dropped from 4.3% and plummeted. Forget the zigzags, but plummeted. This is from 2008, actually, from 2008, April of 2008. Put that down. This is really important to our stock traders, so you guys need to focus, all right? I'm going to make this easy. It plummeted in 8 years. It plummeted in 2016. It dropped. So imagine this as 4.3%. So imagine this as a $4 stock, okay? Just imagine, hypothetically speaking, that'll make it easier. It's a $4 stock. A $4.30 stocks, right? 4.3 to be exact. So here's a $4.30 stock that in 8 years, dropped to 1.3, $1.33. So what's the loss on that exactly? Let me see here. 4.3 minus 1.3. So the loss on that is the price drop. The yields drop 70%. So from here to here, actually it went there before that. It happened in 2013 too, and then it tried to climb back. Whatever the case, you lost. The bond yields dropped 70%. So if it was a stock, then you lost 70% of the value of your stock. Now, if the bond yields fell, it happened from 4.3% to 1.33% twice, once in April of 2012, and the final culmination, which created a massive double bottom. Same old stuff, guys. W formation over many years. Dragon bullish. That's what's getting played out right now. So here's a massive W formation going on. So here's my quick question, and one of you, one second, who's writing what? Oh, Mike's writing me a long story. Okay, I'll read that in a second, Mike. And I always wish you guys, your family well. Okay, so let me focus on this. So 70% of that, what do you think happened to bond prices, guys? Bond yields plummeted 70%. The bond prices, just approximately, if it's a direct correlation, went up by how much? Come on, I just explained to you it's an inverse correlation. This is not hard, guys, please. I told you that when bond yields fall, bond prices rise. So bond yields fell 70%. What happened to bond prices?
They rose by a corresponding amount.
Okay, does everyone get that? Trent, do you understand that? Because this is really important to what we do. I'm going to tie it in all
Yes.
together. You understand that? Real
Yes.
simple. It's an opposite correlation. Inverse correlation is a fancy way of saying just an opposite the movement. Okay, so bottom line is bond prices exploded higher. I think it's more than 70%, you know, and imagine the people who play bonds on margin, which is pretty much everybody. All right. And I think the bond margin borrowing leverage is far higher than what is allowed on the stock market. In other words, what you have to put down, initial capital. What am I looking for? The word. Your margin requirement is a lot smaller than the margin requirement on a stock, which is generally 50% or 30%. Okay, as stock players, we know that. So bottom line is, it was a massive. Now I'm going to clean it. So there's a massive move in bond prices. They went stratospheric. So it was a bull market in bonds. That's why Bill Gross the other day, so-called bond king, his views on the stock market are horrible. He's always been dead wrong. Even on bonds, you know, he made some serious money. That's why he's so famous years ago. But I don't, you know, I don't think he's that great now. But his exact words were, "It's the end of the bull market in bonds." So what does he mean by that? It means that yields are going to rise. Yields are rising, as you can see. So bond prices keep on falling. So that's why he said that those guys make money off betting on bonds, and that yields would keep on falling. So that means that bond prices would keep on rising, just like a stock price. So they're in a bull market. So the bond bull market, he said, is dead. He just said that like a week ago or so. So that's overall a good thing, because when bond prices are rising or overall interest rates are rising in the general economy, what does it mean? What do you think it means? What do you think it means, Corey?
Market's doing well.
No, it has nothing to do with the market. Of course, the market is not necessarily. Bond prices, if they shoot up, I'll explain to you tonight. If they start creeping up over 3%, your market's not going to be doing well. We're going to be taking a massive dip. But generally speaking, as rates are rising, what is that connotating? Think in simple terms. What does it mean for the overall economy?
It means it's doing well.
That's right. That's right. Or, one of my biggest philosophies, and that's why I've always been like that, okay, is I like to keep things in a very simple, commonsensical way. And then if they get complex, I'd like to explain the complex way. My clients back in the days on Wall Street, both institutional and my high net worth retail clients, big guys, really wealthy guys, they used to love that, because I would take a complex topic and make it simple. Always think simple first, and then get into the nitty gritty. So that's the exact answer I was looking for. What Trent said, it means the economy is healthier, because when the rates are down to 1.3%, that means the demand for money is very, very low. And you can borrow money on the 10-year bond at 1.3%. So that means that there is very little demand for money. When there is less demand for credit or money, what does it mean for the economy? PB?
It means people aren't borrowing, they're not expanding, they're not growing businesses.
That's right. That means that the economy is faltering. The simple answer to that, if you wanted to explain it to a child, like I used to explain to my son when he was 8 years old, probably knows more about Federal Reserve policy than I do by the time I got done with him. Now he doesn't, now I barely get a chance to explain all that stuff to him. But bottom line is, that means that the economy is not growing. That means there's no demand for money. The velocity of money, in other words, money moving through the economy, and not just creating jobs, but expansion, spending, consumer spending, like nobody's bothered. That is known as recessionary. So when yields fall down below 2%, okay, and notice we bounced exactly off 2%. Let me clean this picture here. We bounced exactly off 2%. And this is a very technical pattern. And I know you guys know what this pattern is, but I'm going to go through the two. So exactly at 2%, because psychologically below 2% is somewhat recessionary. That means the US economy is falling into a recession. There is no growth. There is no demand for money. Consumers not spending. All the opposite is happening right now. And it started happening many years ago, by the way, but got accelerated, massive acceleration since President Trump came to power because of his very friendly business policies. But the economy's been expanding for years now. But now the real fast expansion has started because businesses are very happy with the business-friendly policies, tax repatriation, lower rates, business-friendly regulations. I mean, all kinds of garbage federal regulations being cut and all that good stuff. All right? So below 2%, no good. Now, I'm going to bring in the other one, this picture here. And this, listen carefully. This is all simple stuff, okay? January 19, 2018, last week, the S&P yield by month dropped to estimated at 1.75%. That means the yield on the S&P, if you hold the average S&P stock on the S&P 500, then your average yield you're going to get from holding the stock, in the case of bond market, this, this yield is not just a fancy word for interest rate. So, or the rate you get paid for holding that. So if you hold a 10-year government bond, you're getting paid right now 2.64%. Listen carefully. If you hold a basket of the S&P 500, and let's say the stocks did nothing and stayed flat, okay, no movement on the stock. And remember, S&P 500 is a heck of a lot more risk, right? And than holding a government bond. A government bond is the safest instrument, financial instrument in the world, the U.S. government bond. We have never defaulted. There was some talk about government bonds defaulting. Trump made some stupid comments during the campaign. Oh, yeah, we might renegotiate government. I said, what the heck is this guy talking about? Okay, but that's him. You know how he is. Okay, made no sense. And the market shuddered. Like, whoa, what's he talking about here? This ain't like Atlantic City gaming casinos. You're gonna keep on refinancing till they go bankrupt. That's like business stuff. Business guys do that. Business guys on average, do you realize one thing? The average business guy, successful business guy, not everybody, but at least in the Eastern Seaboard, has gone bankrupt 4 times. Trump has gone bankrupt how many times? But that's just the way system works. You know what I'm saying? So the bottom line is that the S&P 500 yield at this point, the reason I mentioned that, because you never make any jokes or kid around about the fact, because this is held widely across the world. China, Japan, they own large amounts of our government bonds. Market took a nice 200-point dip because the Chinese governor, his comments were misconstrued as saying that they're going to slow down or stop buying U.S. government bonds. Like, whoa, hold on a minute here. You know what I'm saying? Listen carefully to this session, because this is going to help you understand why you get blown up on the other side and why you need to change directions really quickly if ever some of these things happen. And I put them down on the post. I'm out of every stock at that point, just so you know that. So no hopium there. You're just going to get blown up. If there is a real major turbulence, and I'm going to explain that very clearly, and a sudden sharp panic move higher in rates, you better get out of every single stock that you have and go short hard. Don't be stupid. So listen carefully, and you're going to make a lot of money. So, but the bond market is generally considered to be the smarter cousin of the stock market. Okay? The credit guys, as they're known, are known as the brains. The stock guys are known as gamblers. Fine. Because the stock guys play with risk, the bond guys play with safety. That's why the bond market is known as the safe haven. During times of crisis, anywhere in the world or here, you notice that the bond yields fall. And why do bond yields fall? Because what's happening? Is money coming out of the bond market or going into the bond market? The word on days, okay, let me teach you something which I've mentioned before. What does risk off mean? There's certain days you'll hear on CNBC or read on Bloomberg, he's saying it's a risk off day. We have a lot of them. What does a risk off day means for stock markets?
Money's coming into stocks.
Money is what?
It's going into stocks.
No, just the opposite. Just the opposite, dude. That's what. Because risk is always connotated with stocks, okay? So just the opposite, exactly. So risk off means that day you'll notice that the bond market, risk on is what is the days that we want. Risk on is the days that we've been having overall. We are having RiskOn Days. On RiskOn Days, listen carefully, because no other service is going to teach you this massive macroeconomic stuff. Trust me, which directly will hit your trading. No other service will do that. Okay, risk off means you're having the S&P down and money is flying into safe havens. We get risk off days on certain days when there's a political mini crisis somewhere. So when we had the Dubai crisis, when we had the Greek crisis, when we had Brexit, and all that, so many other stuff that happens, all right? When we have like the North Korean missile flying over northern Japan and the markets suddenly drop, those are risk-off days. What happens, and please listen carefully before you answer, because it's all common sense. On a risk-off day, stocks are falling, the S&P 500 is down, all your stocks are down overall. And what do you think is happening with bond prices?
Bond prices are going up.
That's right. Thank you, Corey. Nobody else could figure this out? I just explained for the last 15 minutes, guys. All right? That when money goes into an asset, whether it's a stock or not, if money is flowing into Amazon, is the stock price going higher or lower? Come on, somebody answered that, guys.
Higher.
It's going higher. Yeah.
That's right. You see, the thing is, when I ask an obvious question, answer. Because I asked you an obvious question, the bond market, but none of you answered other than Corey. Yeah, I'm not here to beat you guys up. I want you guys to start thinking like a little bit intelligently. So when money's moving into the bond market, what's happening to bond prices?
They're increasing.
That's right. They're going higher. It's simple. So bond prices going higher. What's happening to the yield? I just told you 100 times, you guys, that it's an inverse correlation. Yes, they're falling. It's not hard stuff. Write them down somewhere and look at them before you go to bed every night. I'm dead serious. So on days that we have like a mini crisis somewhere for whatever reason, bond prices are, money's flowing into safe havens because they're going into cash, and big money, like Mike said correctly, that they go into cash. They just don't sit in cash. Global money moves around the world in big sloshes of billions of dollars and trillions of dollars at times. So they move from Europe to Japan. You know, global markets are all interrelated. So the bond guys are moving all around the world. So bottom line is that they are parking money in the safest haven, which is the U.S. government bond market. 30-year bonds, 10-year bonds, 20-year bonds, 2-year notes, 1-year notes. So bond price. So as they are piling in on days that we have risk off, they're piling in into the safest haven because they know they can park their money there. It's a place to park money for a couple of hours, for a couple of days, for a couple of months, because they know it's safe, even though they're earning nothing. I don't want to get into it, but just a few months ago, we almost had negative rates. There were negative rates in Japan and in Germany. Billions, no, this billions, the big money. I'm talking 100 billion, 500 billion. They were saying, I want to park the money in the government sovereign market. Sovereign means a government bond market, and you don't even have to pay me a rate. I'll pay you to hold my money. So when somebody pays somebody if you go to a bank and say, please hold my $10,000, you don't have to give me a rate. I just want to keep it very safe because I know you guys will never default. And that's what they say to the Federal Reserve. I'll pay you to hold my money there, to park my money there. It's a bad times, guys. That's not good. That means something really bad is happening out there, and we never want to see that. You guys understand what I'm saying? You do not want to see negative interest rates. There was talk last year that the U.S. would consider negative interest rates. I'm like, oh my Lord. And remember my webinars. I said never. We would never do that. That's a death knell. Anyway, I don't want to get into that. So very simply, risk-off days are when the markets are down, bond prices are up, and you'll notice the yields fall slightly. If they fall really sharp, that means something really bad is out there. Let's talk about the opposite. And please, this time answer correctly. Risk on. What are risk on days for stocks? What is the S&P 500 and all our high momentum stocks? What are risk on days?
Money coming into the market.
Yeah, so simple. Exactly. And what does that do to stock prices?
Increases.
That's right.
Drives them up.
Yeah, and makes everyone go wowza, right? And everyone says,
Mhm.
Frank, you're the best. Look at that. I'm buying. They're chasing prices like whatever. That's a risk on day. And then you buy at the top and you lose more money. But because I like buying on risk off days, guys. That's my buy zone, tactically speaking. All right, as James Bond would say, tactical, please, not emotional. Tactical. So we buy tactical lows. Those are risk off days. The rest of the world's out there, including many of you. Monkeys on hot tin roofs, price chasers. You love buying on risk on days. Wrong. I'm not saying you can't buy on risk on days. We chase things which are up and then they go higher, but that's a different story. But generally, if you want the best prices, you want to buy on risk off days within reason, and if the charts are signaling that it's ready to buy. Okay, so on risk on days, bond prices are doing what? Trend. Nobody else answer because I want to teach trend. Trend on a risk on day, which means stocks are higher. Is money going into the bond market as a safety, or is it coming out of the bond market? I'm walking you through the answer.
It's coming out.
That's right. And never answer with a doubt in your voice, because then I can read it. It's like a UFC. It's like a UFC fighter. You hesitate, that's it. The other guy's putting you down on the floor. Always answer with conviction. So you're correct. Money's coming out of the bond market and entering the stock market. Entering the stock market is called risk on, because stocks are risk assets. Okay, so risk on, simple. Risk on in normal terms, it means that we're ready to rock, man. All right, money wants to play in the stock market. So on that day, if money's coming out, as you correctly pointed out, and it's risk on, what is happening to bond yields? Come on, Trent.
On yields are going up.
Oh my Lord. Trent,
Excuse me.
how many times do I have to tell you? Bond prices are inversely correlated. Inverse correlation. That means when bond prices are going higher, yields are going lower. So on the day that money's coming out, I'm going to walk you through this again, and this time you're going to get it. And I want you to write this down.
Gotcha.
This is not a joke. You'll blow up your account one day when I'm not around. And one day I'm not going to post. Because I'll teach everyone, I'll put all the charts out there. I won't make a single comment. And believe me, you guys are going to be in serious danger if you don't understand these basic concepts. Trust me. So, you correctly pointed out, bond price, money's coming out of the bond market, entering the stock market. Okay? So that means bond prices are falling. I'm sorry, bond prices are falling, right? So on the days that bond prices are falling, what is happening to the yields?
Yields are going up.
That's right. That's right. So it's just remember, just the opposite. So as bond prices are falling and yields are going higher, it is actually an overall a good thing, short term. Till now, we're going to enter the real story of why some of the people are worried about what's going on in the bond market, because too much risk on, and as bond prices are falling, there are two things happening. So we're okay with that stuff. Now, right now we have a beautiful. This is almost a picture-perfect chart. This is a very nice, very large. So, here is where we are, which I wanted to say before. Right now, if you hold a basket of S&P 500 stocks, you are getting 1.75% as interest or yield. If you put the same money in the bond market, you are earning 2.6%. Without any risk, zero risk. Now, zero risk in payments, because as the yields are going higher, your actual underlying value of your bonds are going lower, right? But you are at least safe if you hold it for 10 years. Understand that part, right? Because mom and pop think, I'm going to buy a bond. I remember back in the days, they're like, I just want to buy bonds. I'm like, okay, great. You don't think bond prices go lower? No, bond prices can go lower. It's guaranteed by the U.S. government. Yes, they are, sir. They are guaranteed in actual interest payment every month. But they don't guarantee the price unless you hold it all of the 10 years. I didn't know that. And you're talking about rich guys, business guys. No, I didn't know that. Because then they get their statement, they put $100,000 in, that 100,000 is down to 80,000. And they're like, what? What? I never thought prices go down on bonds. That's what happens, guys, okay? So what's happening right now is the price is moving higher rather rapidly. Let me get over this. So right now, as the yields are rising, you are seeing competition for money, especially the so-called, moderate money, not the real heavy gambling money. They're saying, hey, I can lock into a bond at 2.6%. Yes, I know my value will fluctuate a bit, but I can buy the 2.6%, and I can and if it goes to 3, I'll buy more, because then I get 3% of my money. Now, some people say 3% of your money, that's a joke. Well, not really. When you have it, when a big fund has $400 or $500 billion, 3% is a lot of money for pure safety, right? They're not looking to make 100% on options, that's for sure. The bigger the money gets, they play less the fast moves. We're trying to get up there. That's why we're like moving at light speed. When you get up there, you want to allocate a decent amount in fixed income and stuff, and just leave it in there, nice and cool. So they're saying, you know what? These yields are looking attractive. The yields at 1.3% look like garbage. Who wants to lock in 1.3% for 10 years? If they're looking for the fixed yield on the S&P 500 currently, and the S&P 500 the same way, as stocks are moving higher, I'm going to say S for stocks, what is happening to the yield on the S&P 500 or the interest? Remember, all these big companies, they pay a certain dividend yield, right? Apple does, all these other, all the big companies do. So all the big ones. So what is when stock prices are going higher, what's happening to the yield?
It's going down.
That's right. That's right. That's why the yields have gone from about from 2016, just to give you a small example, from November of 2016 till now, they have gone down from 2.1% to 1.75%. At face value, it's like nothing. Hey, it's just gone from 2.1 to 1.75. Oh, really? That's a 350 basis point drop. That means you lost in yield. That's 16%, percentage-wise. 2.1 to 1.65 is 17%. So that means yields have dropped 17% on the stock market as stocks keep on making new highs. You get it? And that is creating a major competition for some of the world's global capital who are looking at this number here and saying, you know what? I'm liking this 2.6%. This is just one factor. This is not the whole factor why markets do what they do. But this is an important factor. So 2.6%, I'm going to go and park my money at 2.6%, and I'll put less money in the market at this point because the market is basically overextended, blah, blah, blah. Got it? So there's competition for actual dollars. So that's not a good thing. That's one of the negatives of what's going on. Now, looking at this, so we're good with that. Everyone understood what I just said?
Yes.
1.75%, 2.6%. Now, the difference between this and this is that stocks, when they go higher, you're locked in at a yield that started from today, from January 19. You're locked in at 1.75% plus whatever price appreciation you're getting. Okay? Like, you look at your lovely Apple, it's paying you a dividend yield of roughly 1.41% right now. Know that? 1.41%, $2.52. I'm looking at my screen. Not that we ever look at that. Who buys Apple for 1.41%? You know who does? Value fund managers. They're like, Apple is slowly trending higher, and they're paying me 1.41%. I love that for holding the stock. So if they buy $1 billion worth of stock, that 1.41% is 141 million. Correct? Yeah, that's correct. Not bad. or 14 million, whatever. That's nice rate you're getting just by holding Apple stock. So Apple's kind of a value stock too. That's why don't expect Apple to ever lose like a 20% of its value. Trust me, because if the Apple stock price falls, and Trent should answer this because he plays Apple a lot. So if Apple, which is right now at $179 roughly, drops to 100 and paying you right now a dividend yield of 1.41%, 1.41%, guys, right? So if Apple drops all of a sudden, and take a wild guess, I don't want an exact number. Let's say Apple drops like to $159, which has done that so many times. This dividend yield of 1.4%, will it go higher or lower? Trent.
It's going to go higher.
That's right. That's right. You got it. Inverse correlation. Falls, this will go higher. I don't know how much higher it'll go, but I can guesstimate that given I can actually tell you how much higher it can go. You just divide the 2.2222. Let me see here. Forget it. Let's say it goes to 2%. Okay? So it goes to 2%. So wow. Stock price drop, but somebody coming in and buying the stock at 159 is locking in 2%, plus the potential, which has happened a zillion times, that the stock bounces back to 170 and you're locked in at a higher rate. Get it? Now you know why there's all constant attraction to this big cap, mega cap, dividend paying babies. I personally don't even know, but I'm looking right now. Does Amazon pay a dividend? No. Well, high time Bezos did that. Okay. Google pay a dividend? No. Priceline? Nope. Netflix? Nope. Nvidia? Forget about it. It's paying a dividend. Oh, Nvidia does pay a dividend. Nvidia pays 0.26%. So what does this mean? I'm not saying this as a joke. That those companies, when they start, and believe me, they will. You heard it here first. In the coming year, and with the favorable tax conditions and everything, start paying a minimal dividend. Do you think that's going to increase their attractiveness, and more value fund managers and fixed income managers says, you know what? Wow, let me go buy some Google now. It's going to pay me, let's say like Apple, 1.4%. Get it?
Mm-hmm.
Yeah. Now, what does this overall mean for the broader health of the market? When you listen to the guys who are always telling you it's all over because Trump is too fat and that the U.S. economy sucks and China's going to eat us alive and the Russians going to hack us to death, you just got to remind them that if our big companies start paying even a minute amount of dividends, there is no big bad bear market in sight. That's what I'm getting at, and that's why Tom Lee, I put that article up, said we have another 11 years of an overall bull market. And believe me, that guy is smart. He looks like the complete nerd out of like that. What was that very funny movie? They did a whole series of them. Harold and Kumar. He looks like this. I'm not saying a racist statement. It's a joke, all right? Just if anyone took it the wrong way. He looks like the Kumar's friend Harold, like a fatter version, right? And Tom Lee is so brilliant. He was JP Morgan. I actually sat into. He was used to be with JP Morgan, chief market strategist, and I had the opportunity to sit into a couple of his, public stuff that he did on Wall Street, seminars and stuff, explaining things. And now he's got his own company, Fundstrat. I think Fundstrat is his company. Guy is just brilliant. And he's got that like chubby little smile and stuff, Brilliant.
So
let me
what is the 10-year that you're worried the most about?
Okay,
3.2 or how fast it gets there?
Yeah, so this is what I'm getting at right now. So covered all that stuff. Yeah, so Corey read my mind as he normally does. So bottom line is I drew a line just in front of you guys today from 2008 to here. And look where we are. We are right at the cusp of this very large dragon bullish, which actually started here. Okay. And we are at the cusp of a cup. This is basically a cup. All right. a nice cup, and we're about to break out. We're about to break out. So bottom line is, the way I look at it, I don't have the billions that thing has. What's his name? I call him Sonny Bono. Pimco's Bill Gross or Jeff Gunlack. But I have been dead right on my bond predictions too. That if we move up above this level, which is around 3.1 or so, all hell's going to break loose with the stock market short term. So at this point, if this was a stock chart, even you guys would read it and say, this is a cup, and it looks like very likely it's going to attempt a breakout towards this level. Okay? Otherwise, what does a cup normally do? It creates a small handle, right? That's right. We've seen that zillions of times, showing you guys in so many charts. It creates a small handle, and that it might very well do. And that small handle could be one of the jitters that we hit with the market on a risk-off day, where the yields drop from 2.6 to 2.4% because money's flushing in. And there are multiple immediate risks that are in the market. One is it's government shutdown stuff. But even aside from that, there's risk in the market going into February because markets are overstretched. And let's not forget that, okay? We could drop 400 points like boom, just like nothing, while you're sleeping, like it normally happens, because it's technically overbought. So that's when you get the money flowing into the bond market and doing. But looking at this here, very simply, this very large 8-year, 9-year, almost 9 years downtrend line is about to get blasted higher. And that will immediately send shudders into the stock market, because they'll be like, that's it. The Fed's going to we're going to get some CPI number, consumer price inflation data at 8:30 in the morning, and it'll be higher, hotter. You're going to hear all the news saying, oh my God, the U.S. economy is really heated right now. You're going to hear a couple of Fed governors coming out and saying, you know what, time to really raise the rates. And the markets are going to be like, whoa, hold on a minute. Because the markets don't want pedal to the metal. In other words, skyrocketing rates. The Fed leads, does not lead. That's the funny part. The Fed actually follows what the bond market's doing. So if because bond markets react a lot quicker than the Fed meeting every month. The bond market reacts in 5 minutes. You understand what I'm saying? So if we see a risk-off type of day, I don't care how much stocks are dropping, I ain't going to be a buyer. I'm letting you guys know. And that will, and this zone here, where we are going to break out over, let's say 2.7%, there is going to be a sharp move here. Now, why will that happen? Because the prices on the corresponding bonds will have one of those capitulation sell-offs, right? So bond prices, which I call BP, drop very quickly, just like a stock price. When a stock price or an option price drops very quickly, do you sit there and say, oh my God, I'm going to lose all my money? Generally speaking, you will, if it drops really fast too quick and you have a chunky amount, you want to preserve your capital. So you take the loss and stops are triggered, correct? Yes or no? In yes. Some cases. Or if you're holding a stock. If you're holding Juno at 68, let's say you own 200 shares or 400 shares, whatever case, or 100 shares, and that stock plummets and it breaks all the downside thing. What, you just sit around and say, oh, no problem, it's going to bounce? No, you get stopped out because you probably have, let's say, 10% max or 15% or so if you have any type of substantial position on the overall thing. So stops are triggered. Same thing with the bond market. If you start to see rates rising, technically moving above this, bond prices are going to plummet very quickly and this happens very quick in the market. So that's going to create yields to rise faster, and you're going to hit this 3% level. So like Corey correctly pointed out, it's not always where the rates are going, but it's the speed of acceleration. Right? So an accelerated, what we call an impulse move higher, will cause jitters, causing bond prices to get sold off big time, which causes what? If a price of an asset falls rather quickly, what does it cause?
Margin calls.
Thank you. Big margin calls, not your mom and pop variety margin calls. You're talking $100, $200 billion type of margin calls. Those margin calls are sold out of hedge fund portfolios who hold bonds and they hold stocks too. So what happens to your favorite stock on the front side?
Your companies like NVIDIA get clobbered because that's where they have a lot of their disposable money.
Yeah, not just NVIDIA. They generally those type of hedge funds who owns a lot of fixed income. They don't buy individual stocks. They buy S&P baskets called SPY. Got it? Or they buy a leveraged S&P fund. ETF. ETFs are actually owned, and ETFs are owned through leverage. They borrow a lot of money. They get blasted. So it's not just NVIDIA. So you sit there and wondering, why the hell is everything falling? Well, I'll give the reason, and after today's session, you'll know why. And believe me, it's gonna happen. I'm telling you right now, it's gonna happen. Be prepared. Don't blow up your account. Now, can I sit here and project exactly when it's gonna happen? No. But am I watching these things for you guys on your behalf so you guys don't get kicked out on the road again? Yes, I'm doing that for you guys, okay? I'm doing that for myself too. So this is what happens, guys, okay? So any type of very fast move over this breakout line, markets are going to sell off on the front side because there'll be huge margin calls on the sellout on the bond prices as they're crashing. That's going to affect stock prices, and it's going to be a mini, short, fast and furious, ugly sell-off. So that's number one. Number two, this is where the danger zone is. This is where stocks plummet 1,000 points. Letting you know right now. I don't care who you love, whether you love Apple, whether you love your dog, whether you're in love in NVIDIA. I don't care because you know me. I'm in love with no stock. I treat them as numbers. Do I like certain things about certain companies? Absolutely. Do I ever fall in love with a particular company? Never, because they don't love me. And so you guys, some of you who fall in love with any particular company, don't do that. That's the fastest way for you to get demolished. Because Tim Cook, great guy that he is and all the great jobs he's going to create and all that stuff, doesn't give a hoot if Trent Kelp loses $15,000. Thank you. Now, listen carefully. Any breakout over, and this is very critical, and the biggest boys out there who are managing trillions of dollars, managing hundreds of billions of dollars, they're telling their market strategists are basically who get paid like frigging $2.3 million a year are explaining these to their top guys, okay? And you guys are getting it here for free. The bottom line is that if you break out over let's say 3.1%, and believe me, I'll be walking you guys through it. But I'm just letting you know, if you're breaking out over this 3.1%, this is bond prices are crashing hard, stocks and bonds. So there is a certain level over which both stocks and bonds are going to crater. Okay? And that level, to be honest with you, is about 3.1%. Because if it starts to go like this is the point where I believe what I call, somebody fill in the blanks, what do I call this? It starts with
bear
a P.
kill zone? Okay.
Well, this is the bear kill zone, yeah. Well, the bond bear kill zone. But what do I call this whole move?
Dragon bullish?
Nah, there's multiple patterns in there. It's a simple, you guys are all close, but this is pattern completion. Right? Yeah, exactly. Just like a pattern completion. That is pattern completion. Gentlemen, the pattern completion is 3.8%. Okay? And at that point, the market will have corrected substantially. If we move from here to here, I believe you get a 5 to 8% correction in the market. It's going to feel like Armageddon if you're stupid. And I'm going to make a crap load of money because I'll short the crap out of the market and sit there. Okay? Because a 5 to 8% correction we haven't had for a while. So if we're at 26,071, 26,071, and we get an 8% correction, will bring us to 24,000, which we were just on just a little while ago. But that feel of 2,000, 24,000, a 2,000 point drop, it's roughly 2,000 point drop on the Dow Jones Industrial Average. It's going to happen within a matter of I would say if it's the faster and the uglier it is, that means the puts are just going berserk, is better. You don't want a long-winded, slow torture. You don't want waterboarding. Okay? Put a towel over your head and pour some water. I'm just kidding. But anyway, so bottom line is that you don't want waterboarding in the market. You want it fast and furious. And you want to be on the right side of that fast and furious. And go tell everybody that you know that a big, fat, ugly drop is coming from probably slightly higher levels, and that you got to be a clueless at trading to know what to do, because they will not know what to do. And by the time it gets here, all the bozos, as usual, are going to be like, that's it, no more stock market, I'm never going to touch stocks, blah, blah, blah. And we'll be buying with hands down. End of story. So I'm watching this very carefully. Okay,
hey,
yeah.
Clue, do you think?
Go ahead.
Do you think on that where you showed that cup was, like you always taught us before, the depth of that cup is about 6, so that at least comes up to 3.2, wouldn't you say?
Yeah, this is roughly a very good point. This is roughly 6 or 0.6 actually, 0.6. So 0.6 will break. Yeah, because once it hits this level, it's not like automatically it's going to sell off. There's going to be so much panic. I would like to draw another line, and great point that Corey brought out. I would like to draw another line, and that would be it here. See this? Because to me, I'm a chart reader, so there is a pattern. This was a big pattern sell-off. Yeah, exactly. So the depth of this cup, just like a stock, add it on over this breakout, you're looking at about 3.2%. Now, if it goes to 3.2%, immediately you're going to get a quick sell-off, but the pattern is not complete till 3.8%. Now, here's the good news. Here's the good news. As rates, if the rates climb not in straight lines, we don't want to see things like this. We want to see things like, we want to see slow, contained move higher. Zigzag moves higher, okay? We want to see something like this. We don't want this, like straight line type of up. That's when the market's ready. We want things like this, like zigzag, zigzag, zigzag. So if it zigzags its way higher, you're not going to get a 2,000-point drop. You understand? Because there'll be time to adjust to things. It means good things are happening in the U.S. economy. We are back to like vigor, 4% type of GDP growth. Banks are at that point, you know, notice the banks are doing great overall. You know, on certain days they don't. But but just in general, look at BlackRock Financial. I traded the earnings, made some real decent money, and the frigging thing went up another 700% on the options or more. And BlackRock is sick because it is the largest money manager that most people don't know about. Look at BLK. The chart is like sick. But anyway, so the point is, if it's a contained move higher and not an impulse move higher, like crazy, if it's contained like this, you know, normal back and fillings, then markets are okay. Then banks will rise substantially because interest rates do help banks. You know, after all, they're in the business of giving loans. So we're okay with that. So a contained rise to 3.8% should be fine. A sharp rise will cause jitters. And at that point, I believe we will have pattern completion. And if above this, I think the market basically won't like it, because overall rates at that point, the cost of borrowing money will for companies as well as for individuals will be on the rise. Okay, so we're done with the bond side. Any quick questions, anyone? Because this was very important.
I got one.
Go ahead.
I got one more.
Go ahead.
With respect to the SPY, you know, as the asset value goes up, the dividend yields goes down.
Yeah.
But since they're going to have so much money on the tax they're saving, maybe they might make up some of that dividend yield by giving it back with.
Excellent point. Excellent point. I have nothing to say. Brilliant point, Corey. Because they might boost the dividends and increase the dividend payouts, you know? And they should do that. They should use that for helping their workers. Helping their workers at the same time boost the dividend yields for shareholders. After all, shareholders should be rewarded for putting money in those companies. Despite what a lot of the socialists like to say, oh, you can raise dividend yields, it's all selfish. Selfish for what? So bottom line is that, yes, that's correct. So we might get a corresponding move higher in dividend yields. There's many factors going in the market, which is very positive. One is the number of stocks out in the market, as in the number of shares has depleted big time. depleted big time. All right, and so there is a scarcity of it's like a housing market. If there's a scarcity, then prices remain high. And believe it or not, the number of shares out there because of company buybacks has dramatically decreased. So all right, so let's take a quick look at like we normally do. I'm going to move all the lines here, clear the drawing set. Whichever way you slice it or dice it, if this is where we are right now, that's another bull flag. That's another bull flag, and this is a weekly chart going all the way back to 2015. But forget that. Just look at this. So that's another, and this was the elections. 1 second. There. All right. That's another bull flag. Now, bull flags keep on going higher and higher. They can perpetually go higher. So I have projected that, you know, around the 2840 to 2860 level, we should hit a roadblock. That's my opinion, because this is the what we call the wave 5, where things are getting a little too hot, and you're starting to see like, oh, the markets can't go down type of talk coming out, and that is not good. But at the same time, so many people are not in the market that they're starting to come in, and those wave 5s don't end in one day. They generally tend to end over a couple of weeks. So let me just draw out where I think I'm going to do SPX, because so that we don't have to convert the number. Oh, I already have my chart on SPX. Hold on.
Well, like you also taught us, Frank, is
Go ahead.
there comes a point that we're getting too far away from the 50 highway, like you would always say.
Yeah, and there's a lot of factors. We're overbought, high momentum. There are 70% of S&P stocks apparently are above their 50-day moving average. There are warning signs out there, no question about it. I keep on raising these arrows because this frigging market doesn't stop. Seriously. But then I look at some of these stocks and they're like, what if those stocks go higher? I said months ago, if you remember, in one of my webinars, okay, that what if, because that's called sector rotation, what if the energy stocks start getting on fire like they did, like EOG and stuff? That's another leg in the market. So imagine the biotech really go into a merger frenzy and a couple of blockbuster drugs are FDA approved. That's another sector rotation. So it's like you always have somewhere to make money. You just have to be, so the bears always keep on thinking everything should just fall in one go, everything. It doesn't work like that. Enough sectors out there which are still not overbought. So one second.
Also, Frank, it was like Delta.
Yeah, look at Delta. Look at the airlines. It's just
when they came out, they revised their earnings 20% just due to the tax effect.
That's another major factor in the market, because most of the companies have not taken into account after paying the initial taxes what boost they will have on the tax repatriation. That's a major boost that is not being factored into the market right now, even though the market's overbought. So let's take a look here. This is where the big rally started. That was on the 1st, right there, the 1st of this year. Well, the 3rd of January. Bang, bang, bang. This is where we are. We are moving, again, we are diverging substantially from the moving averages, like I always talk about. Here's your 5-week moving average, which is right now trying to catch up desperately it's at 2740. 2740. All right? That's the 5-week moving average. The orange line, let me clean out this chart a little bit. The orange line on, let me take this out, put all these lines back in later. The orange line here, the blue line here is your 20-week moving average. That's at 2600. Okay? And the 50-week moving average is at 2500. 2491. So without really look at it visually, forget about the numbers. These are massive standard deviations. Like I explained many times, we are veering away from the overall moving averages or the highways in a rather rapid pace. That is the normal characteristics of the Elliott Wave 5. The final climax move, okay? Doesn't mean it's the end of the world. That simply means we're going to have a nice substantial pullback. Now, what will start that? Will be technically one, pure overbought conditions, heavy. The final wave of that money pouring in, we've started to see that. From retail investors to the mutual funds, individual stock buyers start getting giddy. Okay, we're starting to see that. You start to also see some the market not caring about what the effects of higher rate hikes, possibility of rate hikes, are starting to care about. So all those factors are there. My gut feeling is that by the time February rolls over, we are going to be extremely cautious, and I'm always cautious, and that's why I have my real-time site, so you guys know, what the heck's going on. I'm not, I don't sit here and make plans to get super bearish. I just don't do that. And but I am ready to react anytime. So be faster with your profits. Don't go nuts. Pedal to the metal when things are moving fast. Take the money down, because we are very stretched on every single metric on the overall longer-term picture of where we are with the markets. And we could, like I said, another 100, 200 points is nothing. Another maybe we're at 2671. Round figure I'll give you, and you can write this down, 26,500. Did we go to 26,500? Hold on. I don't know. Like, I can't keep track with the Dow. We went to 26,153. I had said 26,075 on the last webinar. So 26,500 is a round number. That's roughly 430 points from here. That's roughly another 60 points on the S&P 500. So around 2870. And keep these numbers in mind. 26,500. I would say, give or take, time to slam the brakes a little bit. Now, slamming the brakes doesn't mean they're going to make it that easy for you to short and just walk away. They'll kill you. I've tried to short here and there, made some serious money, as you know, intraday. If I leave it out there for more than a day, I get burned. So, Anyway, so this is what we're looking for on the Dow Jones Industrial Average. This is what we're looking for as max upside, as I like to call it, 2870. And so we got roughly another 400 points or so that we can zigzag. Earnings season is starting full blast, right? It's going to be just like any other earnings season. We're going to see some big moves on these big cap stocks. Do not expect. And Netflix starts off on Monday, tomorrow. Government shutdown or no shutdown, guys. Netflix is tomorrow after market. I'm playing it long with a small with a straddle. Not going crazy, and we're going to look at Netflix. So we're done with the stock charts. Any quick questions? Anything? No.
I got one quick one. How about the government shutdown? What's your perception?
I don't want a government shutdown. Government shutdown, we're going to be hurting bad tomorrow. Just letting you know. We're going to be down 300, 400 points. Period. And I'll be a tactical buyer depending on it. I don't want it to happen because I got some nice long positions going and stuff. I've already calculated. Look, I looked at my account and said what my max losses would be first thing in the morning if they can't get anything done by 1 a.m. It's not a joke. The markets are overstretched. And the last thing they need right now is a government shutdown. Government shutdown overall does not hurt the economy that much because these guys have made sure, the Trump team has made sure that many of the regular stuff stays alive. But do you know what it's going to do? The confidence of the financial markets, they're like, come on. That means that any other type of big plans that might be coming up and stuff, whether, that means the government is non-functional. And overall, it's not good. So that's your answer. All right. So let me move on. So Netflix is what I did was I did a Fibonacci extension. So the Fibonacci extension on Netflix, I'm going to bring it from. Let me see here. It's very okay. This is the breakout. Okay, perfect. So what I did was I tried to figure out like where this thing can go. I'm going to be drawing some lines in front of you guys. This line, for example, has already been taken out. Make it a blue. Sure. Hope. Okay, so there we are. So what I'm looking at on Netflix, straight out. I constructed this Fibonacci extension based on what I consider to be the most recent breakout from 2017. All right, which was right here. This big fat candle. We were there. This big fat candle on the weekly. Where the stock moved from $98. It was earnings, I believe, to 128 during that week, was the first tell. Never mess with these type of candles on the weekly. Was the first tell that the stock was going to go higher. And that was on October of 2016, right before the elections. Earnings, third quarter earnings. Okay? So bottom line is, since then, the stock has, has crept higher, had rough days, stuff like that, standard procedure, had 5 days of selling. Doesn't matter. So this is the way I constructed it with the 0% origination point on the Fibonacci on that breakout. Okay, on that breakout, which I said would be around this level, 131. So measured on that is what I call, what I don't call, but it's called extreme Fibonacci. Extreme Fibonacci is 261.8%. Okay, so forget that for now. Let me not go crazy. Good numbers, and remember, I'm not an analyst. Believe me, I'm a pretty damn good analyst when it comes to scouring through balance sheets and income statement stuff. But again, you guys don't try to be an analyst. Just watch the price action. Read the report. You won't understand crap of it, okay? Because it doesn't matter what it's in there. But if they have, let's say, overall good numbers, and you'll see the reaction in the aftermarket. The stock will hit 249, between 240 to 249 fast. And you want to be out of Dodge at that point, and then look for re-entry if needed. Fair enough? Downside. Downside, I am looking at the stock. Downside on Netflix, I'm buying it more. Netflix in global expansion. I've been saying it for years now. I don't even watch Netflix. Once in a while, I'll watch a documentary or something like that, or watch some old show on it. And I'm still paying. It's invisible money just going there. You know how many it's happening? To a million others are doing the same thing. They just have it for the convenience. Aside from all their big content and stuff. So if it falls, it's going to fall fast after hours. Those 2-minute drops. It's going to drop immediately to the 10-day at 207. Boom, 13 points. Maybe there's like something in there, like, oh, we're going to slow down this or whatever. Or in Slovakia, they stole our content, or the what do you call it? The Ukrainian Netflix pirates, which, believe me, there's a lot of them. Okay, they are the Chinese. They stole our copyright and whatever. If they mention anything like that, who knows? They might. Stock will drop to 195 real fast. So that means 26 and 5, 31 points. Boom! I will be a buyer. You got it? So that's it. Zooming, this is a red doji on the weekly. So there were some sellers, which is fine. You can never read earnings. Charts are just there to show you what the probabilities are, the game theory outcomes, and we play it. So I'm going to play Netflix with a long bias with some short puts. And I am going to buy it if it hits the 194, 193 level. If Netflix starts to go towards 180, I am going to short the stock. If the stocks come close to 183 and then moves, there is going to be big selling. There will be a candle, red, ugly, like this, and the stock will hit 150. Just letting you guys know. And that'll only happen if the stock breaks 180 on volume. But of course, I'll be there to guide you guys on that. So that's where we are. With Netflix, there's a lot of other earnings coming. Let's take to name a couple of quick stocks we can look at because we're going to start wrapping this up.
Hey, Frank, I'm sorry to bother you again. I want to ask you one thing about the government shutdown. I saw something that just came up on CNBC.
Go ahead.
It says, as the government shuts down, it's the second day, Republicans are getting behind a plan to keep the government funded through 8 days.
I know.
I mean, through February 8th.
I know. That's
so would that, okay.
Yeah.
So would that still, so if it's still they vote against it, you think the market would take a hit even though they're going to keep it funded through February 8th?
No. If they get that resolution passed on the floor, which they're trying to do, okay, February 8th, the market's not going to tank. They won't like it. But it's not going to tank. Okay, futures are down 3 right now. Let's take a quick look at E-minis and what they're doing. All right, futures are down 3, which is fine. That means the market's not worried at this point. You understand?
All right.
But futures react very quickly, and the European guys and the Asian guys who are monitoring our markets don't have a deep understanding. Believe it or not, the guys are a bunch of pirates. Okay, of that deep an understanding of what the heck's going on there. I'm not saying that we all do, but I think I do a little bit better than those guys out there because those guys trade these futures like, just hot potatoes. So at this point, if you look at, let's look at some short-term picture here. Futures are down 2 3/4. Let's say, for example, I told all of you guys, and you guys being such loyal, great people, decided to short the crap out of the market on Friday, right? Because let's say I went like totally loony. By the way, the days when let's say for someday I tell you guys like that's it, the market's completely, I'm going totally short and stuff. You know what to do, guys, right? Like if I go dogmatically bearish, do you guys know what to do?
I think so.
What?
Buy some SPX puts and some VIX calls.
No, when I go really like crazy, which I don't because I'm very level-headed, I want you guys to short me, all right? You go completely against me. If I go like, hysterically like that's it. No, I'm half kidding, okay? But I normally don't. But I have noticed, and I've suffered this, I paid my price, dues, in the past 2 years or so, that because I've showed you all the tools that you need to see. Like, and you can basically gauge that when I get a little bit too excited, because come on, it's not like you can always take your emotions away. And I buy a few more extra puts instead of buying 4, let's say at 6 or 7, if it's deep in the money or whatever the case, or like, 3 or 4, I buy like 20. The chances of me losing money are really, really high. So if I go really nutty, like that's it, all over, which I'm not going to do. But if you ever see me do that, feel free to go against me. All right. Feel free to say, you know what, I'll buy a little bit, but I'm going to buy a bunch of calls too. So I'm half kidding, but it's true. But you're never going to see me that emotional. So let's take a look at these charts here. And what we can see here is on the 1 hour, if we were trading right now, we could fall and test right there. Oh, come on. This is the roadmap for tomorrow. This is a very good looking chart, as I told you. It took patience, but it paid the bills. All right. It's basically a very sharp, that's your systematic selling, institutional selling. It's at this point, it's basically a cup. If you want to look at it that way, it's a nice cup, created a nice little 2-day handle, broke out, and now basically hanging out here. So looking at the chart here, you can see we have 28.04. We're at 28.08 right now, down 2 3/4. We could easily drop quickly on any type of news line coming up right now. 28.04. That's another 4 points. That means we'll be down 7. If we, I think, well, technically speaking, if we hold 2,800, which is 8 points from here, that means futures will be down 11 points, right? Futures will be down 11. If we come down here, we'll be down minus 11. Anytime people see futures down minus 6, 7, 10, they like start freaking out. I start looking at the charts to see what's going on. As long as we hold this, And the next level, which somebody should point out to me, is what we should hold. This. There you go. Multiple layers. So let's put the numbers here. So that's the reason why these roadmaps are so critical, because we already know what can happen. Hold on. Don't no one talk right now, please. Let me just do this. Just bear with me 1 second. That's 2805. Let me do this. I'm just looking at all the inflection points and putting it out there. Right. This would be a huge buying opportunity. On the right, 2780. This I'm going to put in white so we can see. Good. All right, so the lines are very defined. We got 2800. We got and you guys can do this on your screen too. So we got 2801. That's the uptrend from Tuesday. Very important. Very important. We break this, we're gonna fall quickly. So if, excuse my French, if crap really hits the fan, then we should expect to see futures down from where we are right now, 2808 to 2796 within seconds. I really don't want that, but hey, what can I do? Just explain it to you guys. So what's the drop there? That's 4 and 8. That's 12 points, right? 8 and 4. That's 12 S&P points. And then you will see a further drop here to 2791. If we drop to 2791, that's 17 S&P points. If we drop here, that's minus 17. That means my S&P calls, which I sold along the way on Friday, but I still have a bunch, is going to look like crap. And then I'm going to buy heavily, depending on what I see on the charts and what is happening on the front side. And so far, you know, the internals are not telling us much. With your questions, please. So that's the read on your S&P 500. All lines drawn.
So I just noticed that they're not doing the vote at 1 a.m. today. They're moving it to 12 Eastern tomorrow afternoon.
Where'd you see that?
StockTwits.
Okay,
So
let me see. I normally check the Hill because they report directly what's happening in Congress.
Yeah.
Okay, that's not bad because the markets didn't react too badly on that. 1 second, I'm looking at. Is there a link there on the thing?
There is no link. There is no link, but it says live squawk. It says Senate cancels vote on stopgap spending bill previously scheduled for 1 a.m. on Monday, and now Senate to vote on stopgap spending bill.
1 second. I'm seeing it. Instead, the Senate is now set to vote at noon on Monday to end debate on a measure that will fund the government. It's not clear, however, given opposition 60 votes in needed. Okay, there's a couple of ways you got to look at it. Marcus they don't seem to be reacting badly on that news, which is good. That means these guys are getting somewhere. You understand what I'm saying? So they're not saying like, you know, they're like, I just want to do it by 1 a.m. I like the market reaction. The market reaction is good, down 2 3/4. I don't want to jinx it, but what do you call? That's 6. Yeah, so that's good. That means they're really getting down into the, you know, just whatever it takes. Seeking to seek compromise. Okay, thanks for letting me know that, because that was important. I mean, I would see that. And Senate fails to reach deal. Okay, good. So this is where we are. So guys, are we good for tonight? Or any other quick stocks you want me to look at? You want me to look at? I want to look at any other quick stocks. Sure.
Apple, please.
Sure, because Apple is you know, controls the market. Apple looks damn good. I mean, you know, the lottos didn't work on Friday, but who cares about the lottos? That's why they're lottos in 8 cents. When they work great for us just the day before. So bottom line is this chart looks really good. And I'm going to draw some broad strokes here. Systematic institutional selling, stop, you know, all stops triggered, and then the rise. So right now it's kind of, it's one of those like Arabian cups, right? That's what it looks like. Apple looks like it wants to go to 180 and 181. All right, and that's what it looks like. And on the downside, we know what the downside is: 175, 173, 172, and if things really fall apart, 169. But generally speaking, at this point, 170, 175 is where you want to basically put in the big guns and start buying it pretty heavy, right? So that's really what we're looking at. But the chart-wise, when I look at that quickly with the candles and everything, we're looking fine. And if we want to look at the internals very quickly, that looks great. And this is on the 1-hour charts. And on the daily, Apple has everything's overbought, so there's nothing new about that. But 1 second here. On the daily, I would say, it's a bull flag. Again, big hammer, right? Big fat, you don't want to mess with that on volume. And then 2 days of doji consolidation hanging over the 5-day moving average. Looks great. And what's this thing doing here? 1 second. I just noticed one thing. This could be the tell. We're starting to see the first signs. If we focus, sometimes you got to squint when you're looking at the charts. Hold on. This. 1 second. Do you know what I'm going to say? What it's trying to do? I'm sure one of you knows what I'm going to try to see.
I think you're looking at the 34 starting to come down a little bit.
Nope, starting to go higher. The crossover is beginning. See that trend right there?
Sir.
You see that? The 34 crossing over the 50. Me likey. That's good. It's not as defined. You want it to basically go like this. It's not coming down. It's going higher. And the 50 is basically now going to be dragged higher. Because remember, when the 34 gets dragged higher, it'll drag the 50. After all, what are moving averages? They are the averages of prices over the last 34 to 50 days, right? So this little thing that we just noticed, and I just noticed for the first time, is a pretty damn good sign that the stock has enough momentum. And the pattern, like I say, just play Apple. This is the way I do it. Overall, just play Apple for 2 points, whatever, because the options move. Now, if we do see a sustained trend where we start to see, let's say, the second day another green candle, and then that generally speaking, Apple goes up 3 days in a row, 2 to 3 days in a row. So if you want to keep your money and keep it pulling it down and then buying it back and then playing it, just got to do it on 2 to 3 day stretches. You can see that 1, 2, 1, 1, 2, 3. 1, the first day, then 2 days of consolidation should be breakout and 181. Just do day counts. 1, 2, 1, 2, 3. This was the big breakout. You don't see those too often. So basically 36 to 72 hours max hold on Apple. And play it during the day when it's moving, because you know what it does. Active traders, we know what it does. Goes up $1.52, then all of a sudden a big sell program comes in. You're like, oh my God. And then, so just play that $1.50. Let the calls go from 60 cents to $1.50 or $1.75 or even 90 cents. Just keep your profits close to you, because we're in a tricky market here. All right. On that note, have a great evening. See you guys tomorrow. And I hope this
Thanks,
free webinar, not a problem. Corey, always a pleasure. And what was I going to say? Make sure that that everyone reviews. The new people are going to listen to this. Re-review sometimes the bond market thing, because that's high-level macro stuff, but that is directly relevant to what we are doing on the front side. And we always want to be well prepared, well educated, so we don't keep on busting our accounts out. Damaging our accounts. Thank you very much. God bless the USA, and I pray that everything goes well. See you guys tomorrow morning. Good night.